Well, hello, and welcome to this episode of Association Transformation. I'm Elisa Pratt, Brewer Pratt Solutions. Andrew Chamberlain, Elevated. How are you, my co-host, my friend, my colleague? What's going on?
I'm not well. I'm sick. I've
Oh
got
my God.
another
Wah,
school.
wah.
I've
You're,
got another school bug. Honestly,
oh
since
my
the little one
gosh.
started school, I'm just perpetually got this cough and cold, honestly. But
You're
I'm in
like an
London.
old man already. You're like a
I am.
grumpy old man already, and you're
Oh, I'm
younger than me.
stiff as well. My back is stiff and my knees are
Oh
hurt.
my God. I
Honestly.
thought I missed you. Okay, I'm over it. I'm over it. Let's
But
jump in. I've got an exciting guest.
I'm in London and it's sun is shining. So,
Oh, okay.
that's
Sun in London.
yeah, it's
That's
nice for a
new.
change.
Andrew's sick. That's expected.
Yeah.
Okay. All right. Here we go. Here we go. Welcome to our nonprofit friends, our association listeners. This has grown from more than just a transatlantic conversation. This is now a global conversation, and maybe today's topic is most appropriate for that. I'm excited to bring a new friend to the Association Transformation family. Andrew, not something we talk about a lot, but actually one of our most listened to episodes was a financial topic. So
Yeah. Yeah, it
we'll see
was.
how today goes. So I'm excited to bring a friend from Philadelphia, Mark Labady, the executive vice president of RTD Financial, is joining us today. Amongst all these banking meltdown, investment, inflation, all this chaos within the financial world, I thought we'd bring an expert to the table to help nonprofits make sense of this all. And Mark happens to be a nonprofit financial expert. There's a lot of people who try to sell you stuff and they want to sell you insurance or help you with your retirement. Mark does associations and nonprofit financial planning and advisory services, which I
Well,
think is
Mark,
a unique animal.
I think it is, but although you say that, Mark, when we're done recording this pod, I myself seem to be running a non-profit, and financial volatility seems to be something that seems to be dogging me for the last 10 years. So maybe we could have a chat after this.
Again, that just put that into the pile of more Andrew personal problems. This is not a charitable podcast, Andrew. Anyway, Mark, sorry, I apologize for both of us, but excited to have you here. Welcome to Association Transformation.
Yeah, thank you so much. And yeah, I share those comments. I've got a daughter at home, and I understand how the household can always feel like it is a nonprofit. So I get you.
So, Mark, we met a few weeks ago, and it was before, I guess I don't know, implosion. That sounds so dramatic. But I think through COVID, a lot of nonprofits and associations had to put their reserves to the test. Weathering the financial storm that was the COVID pandemic brought financial practices and investment policies and all of these things that are back in that governance binder that we never look at became real life and became, you know, tip of the spear survival topics. What are you seeing kind of post COVID? What are you seeing banking wise? I mean, your phone's ringing off the hook. I'm assuming people are freaked out.
Yes, last week was certainly a very, very busy week as the news hit on Monday of some of the bank failures. And, if we think about it specifically through the lens of associations and other nonprofit types, I mean, it's really bordering on almost a Hollywood movie or at least a Netflix special at this point, right? I mean, we go back and we think about starting with the pandemic and obviously how budgets were, had to be cut drastically as events, which are such major revenue streams for most, pretty much had to be canceled or certainly taken virtual. And then fast forward to last year, as finally where you're coming out of all of those issues from the financial market perspective, nonprofits were served the delightful experience of the worst performance ever in the bond markets and the seventh worst experience in the stock markets all in one year. So here we go into 2023 with a lot more hope and finally some positivity kind of move past all of this stuff. And now here we get some of these banking failures. And so, at least to your point, I mean, I think all this governance stuff, you're right, has just become, like you said, something that now is almost top of mind for every finance committee and every board, certainly not just across my client base, but, those across the industry as well.
Now, I wonder, we used to think of reserves as this rainy day fund, and there was a quote unquote best practice around 6 months of operating reserve. And that's, I mean, what's the new, have the rules changed since COVID? I mean, you sent me something that I know you and RTD developed about the biggest reserve mistakes. And we'll share this as part of our podcast notes. But what's the new rule? What's the new reserve rule, either for operating reserves, cash reserves, all these different categories of protection?
Yeah, no, that's a great question. I mean, I think at the end of the day, as with most organizations, you can't just pigeonhole, a particular industry standard and say that everybody fits that model. So certainly there's a lot of uniquenesses, but at the same time, there's also a lot of similarity, right? And so, you know, obviously based on, the growth trajectory of an organization, the maturity of an organization, as well as how much in reserves they already have today, kind of factor into all of this stuff. But I think more than any specific level, whether you're talking about 6 months, 12 months, or greater, it's really getting back to the why of whatever that number should be, right? And so, too often what we find when we're working with a new client is that they haven't really thought through that why part of the conversation. And so, it's kind of like the story of the railroad tracks, right? Like they've just always been that wide in a sense. And so, too often we find that when we ask these finance committee and boards, why their policy is whatever it might be, in essence, we get one of three answers. I don't know. That's how it was since I got on the committee, or that's what our advisor told us to do. Right. And on the surface, you might think, hey, the third one's not terrible because at least you're, lending to prudent experts, so to speak, to help with those decisions. But again, as these organizations lose that why, inevitably nobody understands whether what they're doing is right, and they have no type of planning to kind of go back to help them understand, what perhaps is that right number for their organization.
All right, so you're making this hard. You're not going to give us an answer. I get it. Maybe last thing on reserves, how often should you revisit your reserve policy? Do you just wait for some big crisis to happen and then you adjust, or is there at least an answer around frequency of review? Give me something, absolutely. Mark, come on.
No, absolutely. That one's an easy one, right? I mean, I think, and this is a great example of your comment about, dusting off the old governance folder. I think, reviewing some of these policies and reviewing sort of the thought behind it really did kind of lapse with a lot of organizations, as we went through much of the last decade, because why, right? The economy was positive, investment returns were positive. There really wasn't, quite frankly, the crises of the last 3 to 4 years that kind of, really brought it top of mind for folks. But I mean, we definitely recommend, and we always, hold our clients to, dedicating at least a portion of one of their meetings once a year to really just revisit and focus on all this. Because again, even if nothing's going on, it's just good for the new members to obviously be engaged and understand, how the past decisions were made to kind of get to that place. And at worst, obviously, when all this craziness is going on, it really helps us take a hard look at things and see if changes are necessary.
I think that's a really interesting point there. So with all this craziness is going on, it allows us to sort of take stock. I need to take stock because I am at the moment, as I'm sitting here, what you're saying is ringing true, it's making sense. I'm getting it. What I don't understand, if I'm sitting here as a member of the finance committee and I'm listening to the narrative and I'm thinking, yeah, I get it. But from a business perspective, what is the impact that we should be concerned about? I mean, last week, we're talking about the bank collapses, and I know over in Europe, Credit Suisse has experienced the same or similar headaches. Just in the last 24 hours, there's been, a takeover. But what actually should we be talking about? Because I think a lot of time finance committees, they understand the kind of the routine business of the committee. They understand the making sure, fundamentally we're solvent. Okay, get that, and that we've got our checks and balances in place. But actually, when something like this happens on the magnitude that it's happened, why? Why is this? Why should we be concerned about this? What impact is it having on us as a business?
Yeah, that's a really great question. And I mean, I think, at the end of the day, I mean, it really starts with the word fiduciary, right? And, going back to the work that I do personally, I mean, again, in terms of focusing on working with nonprofits, I'm acting in that same fiduciary capacity.
Yeah.
And what that means is I'm legally required to act in the best interest of my clients. Now, this might be shocking to hear. Most of the public's not aware of this, but not all of the financial community, and actually the majority, do not actually act in a fiduciary capacity. Interestingly enough, just as many people aren't aware that work in the nonprofit world, and specifically those that serve on boards and finance committees, that they are also a fiduciary to the organization. And they have that same not only legal requirement, but also personal liability that actually comes with that wonderful volunteership. And so, we think about specifically the bank failures and the risks there. I mean, I think what's scary starting at the fiduciary level is it's very easy to explain, to the constituents of, let's say a membership organization, how their reserves are down in value because the market's declined, because they've done all the right things to ensure that, they're positioned the way that's appropriate, right? But what they can't explain is how suddenly $500,000 of the organization's reserves are gone overnight because that bank went out of business and they didn't protect that money with simple FDIC insurance, right. Which is sort of a very basic thing. But yet, quite frankly, we've seen a lot of organizations do it because interest rates were so low over the last 10 years. You felt like, well, what's the harm, right? We're not going to make anything to go anywhere else.
Yeah. Yeah. I think you, when you said there about, the insurance piece, it's interesting because I'm not sure I mean, I've been at events when I've been talking to members of boards of directors, and I raised the question around, insurance, and it escapes them that they even need to be thinking about those types of issues. And not just at a financial level, although obviously insurance has financial implications everywhere. But even, when I've been talking to people about insurance, and I said, I presume your annual meeting is insured. No, why would that? No, what? You can get that? What is that? So for me, there seems to be the question I was asking not really was about, I mean, obviously we understand the fiduciary responsibilities and that we have those responsibilities and can contextualize them in the broader governance piece. But it was really the piece about, well, okay, so in real terms, and you did answer this, but I'm just reiterating, making sure I understand this. In real terms, we've lost a lot of cash. Potentially that's the bottom line for what we're talking about here, and that's helped me to better understand, because on the face of it, I'm sitting there thinking, yeah, okay, that's pretty bad. A bank's gone down the Swanee. That's terrible. Who are people who have been involved in it? But it's not us. But actually, understanding that it could be us, or that the value of the dollar or the pound or the euro has plummeted so significantly. And again, I think the questions around, as you said, inflation being practically next to zero for the best part of 15 years. It's almost, inflation it's not really something we're considering until, of course, the last few months, when suddenly, here in the UK, we peaked, and I think it was similar for you guys as well, wasn't it? I think at one point we peaked nearly 10%, maybe 11%. And it's almost a, not quite a generational issue, but it's certainly an issue where I think a lot of people who are now sitting around finance committees are not necessarily up to speed with understanding the implications of it. Something as, I can't say simple, but something as, what should be simple to understand as inflation. But certainly, so for me, I get a sense that there's perhaps an education piece that's maybe missing around the fiduciary piece. Yes, you have to understand what it is, but we need to lay it out in basic fundamental terms. It's not just about making sure we've got money in the bank in terms of what's our income looking like and what's our expenditure looking like. It's also about, as you say, protecting our cash as one of our major assets. Elisa, you had your hand up. Sorry.
I want to bring to the conversation the perspective of the average, quote unquote, air quotes, board member. And I think in their minds, fiduciary is the ultimate nonprofit F word. Like they want to avoid it.
Yeah.
Whether it's finance, financial, fiduciary, those are the F words that they will pretend to understand, and they'll nod and they'll vote to agree, whatever. Yeah. They don't understand. And I would argue that some executives don't understand.
Yep.
This isn't just about protecting investments and managing risk. It's also about taking opportunity and going and getting those long-term investments, putting your association's money where it can be aggressive, putting it where it's diversified, putting it in safe places. And I don't want to miss this window to really ask Mark about the banking piece. What do nonprofits, and I'll just focus on the United States at this moment, if there is a concern that your bank is not soluble or not, in a sustainable status, what do you need to do irrespective of your deposit size or your balance amount? What are the steps that everyone should be taking just thanks to these recent shakeups?
So you put a very key caveat in there. And with that key caveat of, less than $250,000, which is the FDIC insurance limit for an organization, then technically you don't have to do anything. That's the good news.
I thought Biden, even if your bank is, didn't Biden promise that all deposits of all sizes would be protected? Did I miss that?
Let's put it this way. If that is true, if that was actually a factual thing, I haven't seen any press releases on that. Now, my understanding is the Federal Reserve is going to try to act as a backstop for banks to provide the necessary liquidity behind the scenes, but direct to consumers, that's not something that at least I'm aware of. But I think, I had the benefit of being around during the last financial crisis of, 2007 to 2009, where we had hundreds and hundreds of bank failures. And interestingly enough, that's why I think so many people thought, oh, this will never happen again, right? Because, we saw how this played out back then and some of the challenges it created. But I think the real winner of this whole thing is that it's actually helped once again reconfirm for all that FDIC insurance is a very reliable tool. And so, this government-based program, essentially both, back in 2007 and 08, I remember for any clients we had at that time who had banks that went under, that basically they got the full balance back within 5 business days. Here, fast forward 15 years, when the first 2 banks, Silicon Valley and Signature, went down, they came out and had it fixed by the Monday after that weekend. So, as long as you're staying under those limits, theoretically, obviously, while it's going to perhaps create the need to move to a different organization, at least as far as having access to your money and having all of it repaid, is going to be very, very quick. And that's the good news.
Well, we're a little, and I apologize for this, we're a little all over the place, with reserves and bank protections and board training and fiduciary responsibilities. I already know Andrew's eyes have glossed over, which not abnormal. Don't be offended, Mark.
No, actually, do you know what? The financial conversations I enjoy the most. And I think because, often there is a very definite right and wrong answer. You've either got cash or you haven't got cash, and there's ways in which you can protect it, or there's ways in which you can very much lose it. So actually, I find, I think, the nature of the conversation, at least, probably reflects how people feel about it. We are, because you can't always just look at one aspect of the financial without thinking about the others. We can't talk about reserves without talking about financial protections. Can't talk about having financial protections until you know what you've got coming in, your income strategy, etc., or your expenditure profile. I would just add to what you were saying, though. You were talking in the US context there about Federal Reserve protecting up to, I think you said 250, I think you said, was that right? Yeah. So just and again, we'll have to look at others, but for our UK listeners, the FSCS will protect up to £85,000 in each of your bank accounts. So what's that? It's about $100,000 per bank account. So if we'd got, let's say we're sitting on a £1 million reserve, $1 million, should we have our money in different banks, or should we have 10 different bank accounts, or I just wondered how best to manage those in those scenarios. How would you manage that? What do you think, Mark?
Yeah, that's a great question. And honestly, it's one of the challenges we run into very often because, at the end of the day, if you're working with an organization that has a multi-million-dollar budget, right, 250 isn't going to go that far, right? We're talking that might be a month or two of the operating budget at most. And so, I think at the end of the day, it's, rather than having so many different banking relationships, there are other opportunities for essentially what's called cash management. Some of the more sophisticated multinational banks have, in-house cash management programs that essentially are using, you know, for lack of a better word, brokerage products, or basically, FDIC insured money markets, or, buying treasury bills, or certificates of deposit, here in the US, to still provide that same, FDIC level of insurance protection on those safe assets, but also getting the benefit of also earning some money on this. As we know, the quote unquote checking account or operating account, is often not getting a competitive level of interest. So in a way, you're kind of getting your cake and eating it too that way.
Mm-hmm.
So I appreciate. Oh, sorry. Go ahead, Mark.
Oh, no, the only thing I was going to say is, I think the real challenge is that too many of these banks that most of my clients work with, and most organizations I've seen, don't actually have these programs. So the problem is they need to go to an outside third party. And I think that's really, Andy, where they really struggle, because they don't know where to go if they can't get it at their own bank. And so we found a couple really good solutions that we've offered to clients. We have nothing to do with it, but we just think it's such a great solution that, we're happy to introduce it and help to facilitate getting them started.
Well, and I love that. I love that commitment to offering solutions that you don't sell or that you aren't financially vested in. If a nonprofit association of any size, any financial status is looking for a financial advisor, hopefully a nonprofit specific financial advisor, given today's environment, what's the question they should be asking of that potential service provider?
Wow, there's probably 30 good questions that you can ask, and maybe that'd be a whole nother great podcast that you could do it at another time.
Questions on whether to hire Mark and RTD.
Honestly, I'll give you three, because I think there's probably three very different ones, but very good ones. Number one, do they have a focus in the nonprofit area? Because again, I think what we've learned is there's so many what I like to call onesie twosies that are essentially personal financial advisors that, through a client connection or an industry partner perhaps, ran into one or two of these. So really, do they understand that area? And obviously, even within the nonprofit sector, we know it's so broad, right? So I mean, like, the majority of my practice is member organizations, and so versus an organization that's very different than that, maybe somebody else has that right experience. So really digging into sort of what that advisor's knowledge is helpful. Again, I think number two, of course, the fiduciary status is critical, in terms of just making sure that, in essence, the other component of fiduciary is that their compensation is level regardless of what they advise, right? Mm-hmm. You legally cannot be a fiduciary if your compensation is different based on what recommendation you give to the client. So again, I think that's something that most aren't aware of. And then, sadly, I hate to say this, but, know all the costs. A lot of times in the investment world, there's two elements of cost. There's the fixed cost, which is sort of the management fee. And then secondarily, there's the underlying fees associated with building out the actual investment portfolio or program. And so, sometimes, that second piece can be very much embedded and not necessarily disclosed. And so if you're, interviewing a few advisors or a few potential good solutions, make sure you're comparing apples to apples. And that's another challenge that we've seen a lot of clients struggle with over the years.
Well, I so appreciate you pulling back the curtain, because I think this what seems like an uphill battle to even find the right help, the right advisor, and do so in a nonprofit and membership association context is really one of your first steps. I don't know about you, Andrew. I've been scribbling down notes feverishly, because this isn't an area that I am well versed or confident in the changing and evolving marketplace. So this has been a really valuable conversation. And I think, Mark, if I may, I've summarized a couple things, and I really want to try to give our listeners kind of 1, 2, 3 steps moving forward in this volatile economic environment. And, for me, the first thing you mentioned that I know, and a lot of my clients don't automatically have, is a finance committee. A finance committee or defined roles and expectations for their board as it relates to the nonprofit F words and fiduciary responsibilities. Secondly, I think you teased out the need for training, ongoing orientation and education around these areas. Thirdly, you mentioned the need for at least an annual financial deep dive, not only into the organization's situations, but into those market realities. And then intentional and mission-driven reserve policy. You cheated on us there. You didn't give us a real number. You didn't give us a real rule. But what I jotted down was that it has to be related to your why and what you do. And then finally, one we touched on more as a cautionary tale was that risk assessment, the need to understand insurance requirements and protections around that. So that was kind of the top 6-7 things that I jotted down as takeaways for this. Just those first steps, a first look evaluation at how your nonprofit or your association is doing. How safe you are in a financial sense. And this didn't even touch on the FDIC or banking protection. So there's so much here. And it is such an area that's really foreign to me that I really appreciate your expertise and the calm that you come to this kind of topic with. It's very reassuring, and I'm just glad you're a new friend of Association Transformation, and we can turn to you for all the craziness that's I'm sure to come. We didn't even get to talk about crypto, for God's sakes.
No, we're not going to talk about
Andrew's
crypto.
big on crypto, right?
Well, yeah, I am Superman. Isn't that what? No.
Oh my God! But first dad joke of the day.
I was just about to say that was a classic dad joke. Well done. Well done.
Oh my God! See, people are dropping off. I can see our list. The numbers are just nosedive. Oh my gosh, Mark! Thank you so much, RTD Financial. We will share with our listeners as part of the podcast notes your top 10 biggest reserve mistakes. And of course, your contact information. We'll probably need to call you, maybe sooner than later, depending on how crazy the world gets. But thank you so much for fighting for the good guys and putting associations and nonprofits on a pedestal, the pedestal that they deserve, and recognizing that maybe the biggest bank accounts aren't making the biggest impact on our society and our world. Thank you so much for all you do for organizations like this. We very much appreciate it.
Well, thank you. Andrew? It is truly a pleasure to dedicate both, my personal and professional life to this area. And like you said, I wish we could shine the light that it deserves from more in my community as well.
Well, here we go. I mean, I think we're up to 32 listeners now, Andrew. I mean, this is going to skyrocket.
We
Mark
have
and RTD.
Many more than that. And I'm increasingly meeting people who say, oh, I listened to your podcast.
Oh,
and
really?
I stop myself looking surprised.
You're right. We should give ourselves a little more credit. We are award-winning.
Award-winning. We've been doing it a long time now. We're one of the longer serving ones now.
That's true. True. Well, all right. Well, we've raised the bar, and I think topics like this, though maybe uncomfortable for us, are important to bring to the forefront. So until next time, I encourage you to look for new topics, put yourself in uncomfortable positions, push the nonprofit envelope, and put your members and your mission first.